On the 13th of May 2014, the Abbott government handed down its first budget since it was elected. And if ever a federal budget provided an opportunity for financial planners to be able to talk to their clients, then it's this one. There are a lot of measures that were included in this year's budget announcements, but let's focus on what some of these major announcements actually are and how you can actually talk to your clients. If we start off talking about the government's pre-election promise about no negative changes to superannuation, they actually seem to deliver largely to that promise. And in fact, what they did is provide an additional surprise. What they've done is the government has actually announced that for contributions made into superannuation from the 1st of July 2013 that cause an individual to exceed their non-concessional cap, there will now be an ability to have those contributions refunded, including any earnings on top of those. The other change that was announced around superannuation is in relation to the superannuation guarantee. In the lead up to the election, the government had announced that they were looking to freeze the superannuation guarantee increase at 9.25% from July 2014. However, as a result of the relevant legislation not having passed through the Senate, the government has decided to amend this time frame. What will now occur is that it will increase to 9.5% from July 2014, but it will then be frozen at that rate for 4 financial years. And it won't start to increase again until July 2018, when it will increase in 0.5% increments and hit the original slated 12% level from July 2022. In relation to taxation, there were a couple of measures that were announced. The major one, which had been alluded to in the lead up to this year's election, is what they're referred to as a temporary budget repair levy, which is a levy of 2% that will actually apply to people on the highest marginal tax rate. And that 2% will only apply to the extent that taxable income exceeds $180,000. So the levy isn't payable to the extent that taxable income is below that, but only on the amount that's above it. And of course, it's also important to remember that we do have an increase in the Medicare levy rate going to 2% as a result of last year's budget, which introduced the National Disability Insurance Scheme. Other minor changes that came through but potentially have an impact on some of your clients is from the 1st of July 2014, there'll be the removal of the dependent spouse tax offset, which for some people could be a tax saving up to $4,000 a year, and also the mature age workers tax offset, which can give some people a benefit or a tax saving of up to $500 per year. And those changes again are coming through from the 1st of July 2014. In relation to the Commonwealth Seniors Healthcare Card changes, there are a number of changes that were announced. The first of these is the government has actually announced that they'll look to introduce an indexation of the threshold qualification to actually qualify to get that Commonwealth Seniors Healthcare Card. Currently, those limits apply at a rate of $50,000 of taxable income for an individual or $80,000 for a family. And potentially the way the rules have been working is as people's incomes have increased, some people may actually no longer qualify for those sort of cards. But that will change from September 2014 when those limits will actually be indexed on an annual basis. It's also important to remember that there will be some further changes in terms of what counts as income in terms to qualify to get one of these cards. And what the government has announced is that they'll look to include untaxed superannuation income stream payments in relation to qualifications from January 2015. Now, we haven't seen the legislation around this yet, but what the government is contemplating is using the same rules that are going to apply for the deeming of account-based pensions for age pension income test purposes, which means some amount of income out of an income stream from superannuation will count and may cause some people to no longer qualify for these sorts of payments. There were some changes that were announced in relation to the family tax benefit. Perhaps the most important one is that the relevant thresholds and qualification criteria to get a family tax benefit, be it Part A or Part B, will be frozen for 2 years from the 1st of July 2014. That means there won't be any increase in the amount of these payments for people that are eligible. What also is looking to come through from the 1st of July 2015 is actually a reduction in the amount of income that a person can earn in order to still qualify for family tax benefit Part B. And that'll reduce from the current $150,000 for the primary income earner in the household down to a level of $100,000. And finally, in relation to Social Security, there have been a number of announcements that have come out in relation to this space. Again, perhaps what are some of the more important ones or things to be aware of? In relation to non-pension payments, so for example things like a New Start allowance, there will be a freezing of the relevant thresholds to determine the amount of payment from the 1st of July 2014 for a period of 3 years. For pension payments, such as the age pension, a similar freezing of the thresholds will come into play, but that won't occur until 2017. In relation to the age pension, the government has also talked about changing the way in relation to how these payments are actually indexed. Currently there's a variety of ways that can be calculated, but generally what we've seen over the past is that they've indexed at the rate of male totally ordinary times earnings. What the government is now saying is it'll be at the rate of CPI, and that'll apply from September 2017. And generally that means it's going to be a lower increase in those payments on a go-forward basis. And the other announcements really come out in relation to the age pension is the government confirming, as they had announced pre-election, that age pension age is going to gradually increase to age 70. And that'll apply essentially from 2035 when people look to qualify for it then. When you look at all these measures overall, what really becomes important is there are a lot of little things that can affect all of your clients. For younger clients, it might be questions about how do they need to balance their retirement savings in order to provide for an income stream or ability to fund them in a retirement phase before they can actually qualify for the age pension. For those people who already qualify for an age pension or other forms of government subsidies, there's a question about how will these changes impact them. And maybe it's just going back to some of the basics of actually doing a proper budgeting plan and helping people to appropriately plan for retirement into the future, but also their needs today.